Gold didn't crash because people panicked. It crashed because something investors believed would protect it simply wasn't there when it mattered. For years, we've been told that industrial demand would act as a backstop for gold during volatility. That narrative collapsed during this crash. And if you were holding gold expecting demand to cushion the fall, this move didn't just hurt your portfolio, it challenged your assumptions. By the end of this video, you're going to understand why industrial demand failed to support gold, how this crash followed a predictable structure rather than a random shock, and what signals you need to watch next so you're not caught off guard again. This isn't about blaming the market, it's about seeing gold clearly for what it is and what it isn't. To understand what just happened, we need to slow things down and look at the timeline. Price was not the first thing to break before gold fell. Pressure was already building elsewhere. Liquidity was tightening across markets, the dollar was firming, and risk appetite was quietly fading. At the same time, expectations around demand were doing something dangerous. They were becoming complacent. Investors assumed that industrial usage, central bank buying, and long-term demand narratives would automatically step in if price slipped. But markets don't reward assumptions. They test them. What failed first wasn't demand itself. It was the belief that demand reacts instantly. Industrial demand does not lead markets, it lags them. That's the first mechanism investors misunderstand. Think of industrial demand like a rear-view mirror. It reflects where the economy has been, not where it's going next. When markets turn suddenly, industrial demand doesn't rush in to save price. It responds later after conditions stabilize. During this crash, price moved faster than demand ever could. The second mechanism is more uncomfortable. Gold is not primarily an industrial metal. It never has been. Its industrial use exists, but it's not the dominant force behind pricing. Treating gold like copper or silver is a category error. Imagine relying on a fire extinguisher that's locked behind glass during a fire. You know it's there, but it doesn't help you when flames spread quickly. Gold's demand profile is dominated by investment flows, confidence, and monetary conditions, not factories ramping up production. When stress hits fast, industrial demand simply isn't designed to respond. The third mechanism is the most important and the least discussed. Paper gold markets override physical reality. In the short term, futures, ETFs, and derivatives set the price long before physical buyers have a chance to react. Think of it like a theater that sells 10 times more tickets than seats. As long as nobody demands a seat, the illusion holds. But when sentiment shifts, price moves based on paper flows, not physical demand. During this crash, paper selling overwhelmed everything else. Demand didn't disappear, it was sidelined. The data confirms this. During the sell-off, ETF outflows accelerated, while futures volume surged, a combination that historically signals stress driven by positioning, not consumption. Industrial usage data didn't collapse, it simply didn't matter in the moment. Physical premiums barely moved compared to paper prices. That divergence tells us something critical. The crash wasn't a verdict on gold's usefulness, it was a reset in positioning. We've seen this before. In past gold sell-offs, demand narratives failed at the exact moment investors expected them to work. During previous cycles, gold often fell sharply, even while long-term demand remained intact. What followed wasn't immediate recovery, but a period of reevaluation. Price stabilized only after weak hands exited and leverage cleared. The pattern repeats because human expectations repeat. Another historical example shows the same lesson. Gold has crashed during periods of strong macro demand simply because financial markets move faster than the real economy. When investors confuse long-term demand with short-term protection, they expose themselves to sharp drawdowns. The market doesn't punish belief in gold, it punishes misunderstanding how gold trades. So what happens next? There are three realistic paths forward. The first is a slow recovery where investment demand gradually returns once volatility fades. This path fails if liquidity continues tightening. The second is an extended confidence reset where gold chops sideways or drifts lower while investors reassess its role. This path ends only when uncertainty peaks and selling exhausts itself. The third scenario is a delayed repricing where the crash acts as a reset rather than a top. In that case, gold stabilizes first, then moves higher later when confidence erodes again. A pattern seen after previous episodes of ETF outflows and forced selling. This scenario fails only if trust in the system fully restores. What should you do now? Stop watching price alone. Watch liquidity, watch currency strength, watch investment flows. Industrial demand matters, but on a different timeline. Understand the difference between physical ownership and paper exposure. Physical gold doesn't react to margin pressure the same way paper gold does, and most importantly, don't confuse a failed assumption with a failed asset. Right now, there are three types of people watching this. The first is reacting emotionally, assuming the gold story is broken. The second is waiting passively, hoping clarity arrives on its own. The third is thinking structurally, separating long-term value from short-term mechanics. Only one of these groups consistently survives volatile markets. So ask yourself honestly, did gold fail or did expectations fail? Drop your thoughts in the comments. If this breakdown helped you understand what really happened, share it with someone who's confused right now. And if you want clarity instead of noise as this story continues to unfold, stay connected. Because in markets like gold, the biggest losses don't come from crashes. They come from believing the wrong thing would protect you when it mattered most.